Most people spend a large part of their adult life trying to reach one quiet milestone, owning the house outright. Not for luxury, not to impress anyone, but because somewhere deep down, they believe that, when the mortgage is finally gone, life will become lighter. Retirement will feel safer, the monthly pressure will ease. The home will finally become what they always hoped it would be, a place of security. And for many people, that final mortgage payment really does feel like a victory. It represents decades of work, sacrifice, repairs, overtime, delayed vacations, and careful choices. It is not a small thing to pay off a home in America. It is one of the few moments when a family can look back and say, "We did something right." But then, sometime later, another bill arrives. It may come from the county. It may come through an escrow adjustment. It may arrive once a year, or twice a year, quietly folded into the same stack of mail, insurance notices, utility statements, medical paperwork, and credit card bills. And when it does, it carries a truth many homeowners understand only after they retire. The mortgage may end, but the cost of keeping the home does not. That is the part of retirement housing that often stays hidden until later in life. People plan for the mortgage because the mortgage is obvious. It has a due date, it has a payment amount. It sits there every month, demanding attention. But property taxes are different. They can feel like background noise for years, just one more part of owning a home. Until income slows down, until raises stop, until Social Security becomes a larger part of the budget, until every bill starts to matter more. According to the U.S. Census Bureau, about 35 million owned homes were paid off in 2024. On the surface, that sounds like stability. And in many ways, it is. A paid-off home can be one of the strongest foundations a household has. But it can also create a dangerous illusion, the feeling that the hardest financial part of home ownership is over. Because the bank may be gone, but the bills are not. Property taxes remain. Homeowners insurance remains. Utilities remain. Repairs remain. The roof still ages. The furnace still breaks. The water heater still fails at the worst possible time. And the older a person gets, the less room there may be in the budget for surprises. This is why the issue matters so much for older Americans. Census data showed that in the first quarter of 2026, the homeownership rate was highest among householders aged 65 and older, at 78.4%. In other words, millions of retirees are living inside this reality. They may own their homes, they may have built equity, they may have spent decades in the same neighborhood, but they are still exposed to the ongoing cost of staying there, and this is where the pressure becomes more complicated. Retirement often changes income from something that can grow into something that must be carefully managed. During working years, a higher bill may be painful, but there may still be wages, overtime, raises, bonuses, or another way to absorb the shock. In retirement, the same increase can feel different. It is no longer just an increase. It becomes a subtraction from a smaller pool of choices. The Social Security Administration reported that the average retired worker benefit was about $2,082 per month in May 2026. For some households, Social Security is only one part of the picture. For others, it is the center of the monthly budget. Now place a rising property tax bill beside that number. Then add groceries, insurance, prescriptions, utilities, car costs, medical expenses, and the repairs that come with an older home. Suddenly, a bill that once felt manageable starts to feel like a warning. A TTOM estimated that property taxes on more than 89 million single-family homes totaled about $396.8 billion in 2025. The average single-family property tax bill was $4,427 that year, up 3% from the year before. Not every homeowner pays that amount. Some pay less. Some pay much more. Property taxes vary by state, county, home value, local rules, and assessment practices. But the national scale tells us something important. This is not a small background expense. For many households, It is one of the major costs of remaining in place, and where someone lives can change everything. ATTOM's 2025 analysis found that New Jersey had the highest average single-family property tax bill, at $10,499. West Virginia had the lowest average bill in that analysis, at $1,081. That difference is enormous. It reminds us that there is no single American experience with property taxes. But the deeper problem is shared across many places. Even when the mortgage is paid off, the right to keep living in the home still has a price. The real problem is not simply the bill itself. The real problem is how that bill feels after the paycheck is gone. A homeowner in their 50s may see a tax increase and feel irritated. A retiree in their 70s may see the same increase and feel something closer to fear, not because they are irresponsible, not because they failed, but because the margin is thinner. There are fewer working years ahead to rebuild savings, fewer ways to replace money once it leaves, less time to recover from a pattern that slowly gets worse. The Census Bureau reported that median monthly owner costs rose 3.8% from 2023 to 2024. That figure includes more than property taxes alone, but that is exactly how real life works. Retirees do not experience inflation in neat little categories. They experience it at the kitchen table. The property tax bill rises, the insurance bill rises, the electric bill rises, groceries cost more. A prescription changes, a car repair appears, the house needs work, and slowly, the home that was supposed to represent peace begins to feel less predictable. This is where the issue becomes emotional, because a home is never just a line on a balance sheet. For many Americans, the house is where the children grew up. It is where birthdays happened, where arguments were settled, where holidays were hosted, where someone planted trees they hoped to sit under years later. It is the familiar drive home, the same mailbox, the same neighbors, the room where a spouse once sat, the porch where mornings still begin. So, when the cost of keeping that home rises, it does not feel like a normal expense. It feels like pressure on a life people spent decades building. Pew Research Center found that 93% of U.S. adults age 65 and older said they lived in their own home or apartment in the 2025 survey. Pew also found that many older adults want to remain in their homes if they need care later. That desire is not hard to understand. Staying home is about more than money. It is about memory, independence, pride, routine, and dignity. And that is what makes the property tax shock so powerful. It touches the one thing many retirees are trying hardest to protect, the ability to stay where they are. The hidden trap is not always poverty. Sometimes, the trap is appearing comfortable. A retiree may own a house that looks valuable from the outside. The home may have appreciated over many years. On paper, that person may seem secure. But property taxes are not paid with home equity unless that equity is somehow turned into cash. A county tax bill does not care that the homeowner is retired. It does not care that the house is full of memories. It does not ask whether the owner feels rich or poor. It simply arrives. That is the quiet conflict of being equity rich but cash poor. The house may be worth more, but the monthly budget may feel tighter. The asset may look strong, while the checking account feels fragile. And for people who never plan to sell, rising home value does not always feel like a blessing. Sometimes it feels like a cost they did not ask for. From there, the pressure spreads in small ways. A household may pull a little more from savings, a repair may be delayed. A credit card balance may carry over, travel may be reduced. Gifts to children or grandchildren may become smaller. A medical expense may create more stress than it used to. None of these decisions may look dramatic from the outside. But inside the home, they can feel like a slow loss of control. That is how many financial problems begin. Not with one huge collapse, but with small compromises that become normal. There is another detail that makes the shock feel sharper. When a homeowner still has a mortgage, property taxes are often handled through escrow. The cost is folded into the monthly payment, so it may not feel separate. But once the mortgage is gone, the tax bill can become more visible. It may arrive as a larger annual or semi-annual bill. The cost was always there, but now it stands alone. And when a bill stands alone, it can feel heavier. This is why the phrase paid off deserves a second look. Paid off means the debt to the lender is gone. That matters, it is worth respecting. But paid off does not mean cost-free. It does not mean protected from local assessments. It does not mean protected from insurance increases. It does not mean the home will stop aging. It simply means the financial relationship with the lender has ended. The financial relationship with the property continues. Property taxes are shaped by local systems. They may be influenced by assessments, public budgets, schools, local services, and nearby home values. That means a retiree's tax bill can change for reasons that have very little to do with that retiree's personal income. The neighborhood changes, the assessed value changes, the local budget changes, but the retiree's cash flow may not change with it. That mismatch is the heart of the problem. The world around the homeowner keeps moving. But retirement often asks the household to stand still. Imagine someone in their late 60s who did almost everything the traditional way. They bought a modest home, they stayed in it, they paid the mortgage. They avoided unnecessary risk. They entered retirement believing they had finally reached safer ground. Then the bills kept coming. Property taxes, insurance, utilities, repairs, prescriptions, groceries, maybe a car payment, maybe a credit card balance from a year when everything seemed to break at once. No single bill tells the whole story, but together, they tell the truth. The pressure is not always visible from the street. The lawn may still be cut, the house may still look well cared for. The person may still smile at neighbors and say everything is fine. But behind the door, the numbers may be getting tighter. That is one of the most difficult parts of middle-class financial stress. It often looks stable from the outside long after it begins to feel uncertain on the inside. For some retirees, the consequence is not immediately selling the home. It is something quieter, less breathing room, less confidence, less ability to absorb the next surprise, a growing habit of saying, maybe next month, or we'll wait another year, or let's just put it on the card for now. And this is where many households begin to lose control without noticing. Not because they were careless, but because the cost of staying kept rising while the income did not rise in the same way. This does not mean home ownership is a mistake. It does not mean a paid-off home is not valuable. It does not mean every retiree is in danger. Those would be easy statements, but they would not be honest. The more honest truth is quieter. A home can be an asset and still be expensive to keep. A homeowner can be responsible and still feel squeezed. A mortgage can be gone and the pressure can still remain. AARP has noted that property tax deferrals and assistance programs can help some homeowners with low liquid income remain in their homes, and that many states limit certain programs to older adults or people with disabilities. But these programs vary by location. They can involve rules, deadlines, income limits, and trade-offs. So the point is not that there is one simple answer for everyone. The point is that property taxes should not be treated as a small detail in retirement planning. They are part of the permanent cost of aging in place. For people still in their 40s and 50s, this matters before retirement begins. It is easy to imagine a future budget where the mortgage disappears and everything becomes easier. And yes, removing a mortgage payment can make a major difference. But if property taxes, insurance, utilities, and repairs are underestimated, that retirement budget may be built on an incomplete picture. For people already retired, this issue may feel more personal. It may show up as frustration, as embarrassment, as a quiet worrying that maybe the home is becoming harder to keep than anyone expected. That feeling is not failure. It is the collision between a financial plan built for stability and a world where many costs keep moving. For widows and widowers, the pressure can be even more painful. The tax bill may remain, but the household income may change. The same rooms are there, the same memories are there, but the financial weight may fall on one person. That is not just an accounting problem, it is a human one. This is why property taxes can carry more emotional force than people expect. They are not just a government bill. They are a reminder that even after decades of work, ownership is not the same as complete safety. The home may be yours, but keeping it still requires cash, planning, and resilience. The retirement dream is often told in simple terms. Work hard, pay off the house, stop working, finally breathe. And for many people, parts of that dream are still real. But the full picture is more complicated. Paying off the mortgage removes one burden. It does not freeze the cost of living. It does not stop local tax systems. It does not stop repairs. It does not stop insurance. It does not stop time from moving through the house. So perhaps the question is not only, will the mortgage be paid off? Perhaps the deeper question is, what will it cost to stay? That question is not meant to create fear. It is meant to create clarity. Because clarity is often what people need most when money becomes emotional. Not panic, not shame, not blame. Just a clearer view of the bills that remain after the obvious one disappears. A forever home is not only a place someone loves, it is a place they can continue to carry. And carrying a home in retirement means looking beyond the mortgage and seeing the full weight of ownership, taxes, insurance, utilities, repairs, and the slow pressure of rising costs. For many middle-class Americans, the goal is not to look wealthy on paper. The goal is to feel safe in everyday life, to open the mail without dread, to pay the bills without draining the future, to stay in a familiar home without wondering whether the walls around them are becoming too expensive to keep. That is why this issue matters, not because every homeowner should be afraid, but because many people have been taught to see the paid-off mortgage as the finish line, when in reality, it may only be one checkpoint. The mortgage may end, the responsibility does not. And for anyone hoping to grow older in the home they worked so hard to own, that difference is worth understanding before the next bill arrives.